Hello friends, Kurt Triebold here from One Tree Hill, and this is your latest market update. The S&P 500 has had a nice little 3-day rally this week. However, it's still down about 10% for the year on some major downward shifts in expectations since the year started. Obviously, the biggest change has come from what's going on in Europe. The war in Ukraine has no doubt been dominating the headlines, and there simply isn't much consensus on how this is going to play out and what the long-term economic effects are going to be on Europe. But this week, the markets reshifted its focus back to domestic issues, namely the Fed. The Federal Reserve ended its 2-day meeting on Wednesday, and as expected, the committee voted to increase the Fed funds rate by 25 basis points and signaled further rate increases are ahead, possibly as much as 6 more hikes by the end of the year. The purpose of these rate hikes is to slow down the runaway bus, namely the overheated economy and its resulting inflation that came from too much stimulus being dumped into the system during COVID shutdowns. The Fed also adjusted its forecasted GDP growth rate, now to 2.8%, down from 4% as recently as December. Finally, Chairman Powell noted that the committee made good progress on a plan to cut bond holdings and expects to start reducing its insane $9 trillion balance sheet in the coming months. So where does this leave us? Well, the short of it is the economy and corporate earnings appears to be pretty strong compared to historical numbers. But with inflation, interest rate hikes, and serious conflict in Europe, there's a lot of uncertainty looking into the not-so-far future. So, stick to your allocation game plan and hang on for a bumpy ride until some of these issues get resolved. That's it for this week's market update. Stay well, everyone.